Hey everybody, this is the May real estate update. Thought I'd get this out to you here as soon as I could and touch on a couple of things. I've really enjoyed talking with people over the last month about just different things that come up and different topics that come up. I thought it'd be really helpful in this particular episode to talk about certain questions that I get that are recurring questions. So while we'll do some things, we'll talk about statistics locally, we'll talk about some other things. I thought it'd be helpful to also talk about some of the questions that I get. So we'll talk a little bit about remodels. We'll talk about value add propositions to those. We'll talk a little bit about when's the recession coming? Those questions always seem to come up. Talk about rent rates around the area, and then we'll just go through some groups, the group real estate statistics for the month of April, which I found really fascinating and helpful to kind of understand what's going on. So first topic out of the gate is the recession. When is it coming? What's going to happen? When's the shoe going to drop kind of thing? That question seems to come up about every time I meet with anybody and asking me to predict what my take is on it. I can only tell you a couple of things that I think are really interesting in the market. I don't know when it's going to happen. I do think that some of the stuff that's happening structurally with the dollar, I think some of the stuff with inflation, I think some of the stuff with interest rates may have a tendency to put some suppression on our kind of robustness in the market. I think we have some really kind of funny things locally that make it hard for me to say that it's going to just fall off a cliff. I think there are some artificial constraints that remain in the market, both politically and with water, that I think are going to continue to put a suppression on inventory. And by doing that, I think that we will still see pricing remain relatively high. And I think we may see like an adjustment in the marketplace in terms of days on market and maybe over asking price stuff, some of the stuff that's happening in contracts being, where we're seeing people that are being able to ask for 60 days or 60-day close and then another 60 days in a post-occupancy agreement and still being able to get that done, and also over asking price, waiving of appraisals, kind of waiving of inspection. I think some of those things may start to cool off here as we see things come through the summer. But I will say that we just have this really interesting thing locally and artificially, I think, because of politics. There's just not very much new construction. There's not very much new development. Water has become really complicated. We have a whole region of our marketplace that normally would be a relief valve, and it's not even happening. So we still are seeing no new developments even being able to be entertained by the Northweld Water District. They did release permits on existing plats and existing lots. That moratorium has been lifted, but otherwise, any new developments are not going to be able to be happening. We've heard as long as 18 months. So I think that doesn't bode well for new inventory. I think it doesn't bode well for a gluttonous amount of inventory. In 2008, we had nearly 2,000 platted lots in our region that had not even been developed. So that entitlement process had already been done. There were people waiting kind of to do their developments, and those things still existed. We don't have that currently. There aren't any platted. There are some vacant platted lots in our region, but otherwise, because of the moratorium in Northweld and because of some of the other things that are going on with the cost of water and the time it takes to get through the political process, we are not necessarily seeing this glut of platted lots that's not out there. So I do think, I think the cycle in the recession is probably at its peak, for our region. We see those cycles kind of come in 7 to 10 year cycles. The last sort of end of the recession last time where we started to see the turn was 2013. And in 2013, we started to see things kind of ratchet up locally, and we started to see a turn in the housing market. It's 2022, so that's almost a 10-year window now that we're seeing. And I think we'll probably be at the end of that cycle sooner than later. I don't know what that means locally for us. Like I said, I think there's going to be some artificial constraints on that are going to really put some suppression on it. But I think structurally there's real challenges out there. The stock market's battling every day and losing value every day. Seeing cryptocurrency take some on the chin, somewhere people have really had made a great deal of money in that particular deal. Those things have really fallen off the cliff. And I think there's a lot of fear in the market. I think inflation has a lot of people edgy. I think some of the stuff with food shortages, I think some of the stuff where people are feeling like this is just outside of their American experience is putting some nervousness in the market. I still think a lot of people want to live here. I still think COVID has realigned the marketplace tremendously. People are interested in living and working where they want to work and live, rather than having to be in an office somewhere or having to be in a position where they're sort of locked down to go do this in a specific spot. I think COVID realigned that. I think employers are much more open and able to let people go do what they want to do and work where they want to work. And I think that will have an impact on us locally, because Northern Colorado remains a great place to live. I think people still appreciate living here. I think they love the scenery, the mountains, the activities, the availability of all sorts of wonderful things culturally here. And so I think this will just continue to remain a pretty robust marketplace. While I don't think it will be quite as significant as it may have been over the last couple of years, I don't think the next downturn in the recession is going to be one like we saw in 08, where things did tremendously feel like they'd just fallen off a cliff. I don't think that's going to happen this time around. So that's my take on the recession. I do think it's coming. I do think there will be things that are around the corner that will be hard for a number of people. I would watch home equity lines of credit. If any of you are in that position where you've leveraged yourself with home equity lines of credit, I'd be cautious about that. I think that's one of the things that will probably have the most impact, in terms of those are always usually adjustable rates. And so if you borrowed $100,000 to buy a boat or whatever the last time around, and you were doing that at 1.5% or 2% interest, those are now ratcheting up to 5% and 6% interest rates. That's going to change that payment dramatically. I do think that's going to start to impact our market a little bit. I think people are going to need to exit, because I think they overstretch themselves. Anytime credit's cheap, it's something that we see this happen often. So speaking of that, I wanted to do this quick little snippet on what causes a recession. I think this is really helpful information. This comes from one side of the economic spectrum. There's Keynesian economics and Austrian economics. It's kind of competing economic thoughts and ideologies out there. This one actually comes from Austrian economics, and this one's kind of their rationale for why a business boom and bust cycle happens and what causes a recession. I think it's really helpful. I think it gives a little context as to why, when credit is cheap, people make kind of complicated choices, or choices that they wouldn't otherwise make. So take a look at this. I think this is really helpful to kind of give a little contextualization to that.
One of the most contentious ideas of the Austrian school is its explanation for one of the reasons economies fluctuate between booms and busts. According to Austrian economists, the ebbs and flows of the economy, or what we call the business cycle, are often rooted in central banks actively intervening to change interest rates from what they would otherwise be. Austrians, like most economists, see the interest rate as the price that coordinates savings and borrowing. The link with the business cycle is that when central banks lower interest rates relative to the actual amount of savings, it artificially stimulates investment that is not sustainable. Let's explore this with an example. The Central Bank of Prosperity Land believes that interest rates are too high and are impeding economic growth, so it intervenes to lower them. This intervention makes it more attractive for entrepreneurs and businesses to borrow and expand their business. The lower interest rate signals to entrepreneurs and businesses that people are saving more today and will therefore consume more in the future. Ivan is a business owner with a profitable company selling chocolates. Based on the lower interest rate, he decides to build a new factory, doubling his production capacity. 2 years later, Ivan opens his brand new factory and soon realizes that there has been no increase in demand for his chocolates. Interest rates weren't really lower, as they would be if people were actually saving more. Instead, they were made artificially lower because of the government's injection of money into the banking system. Ivan now has the capacity and costs to produce double what he once produced, but there isn't enough demand for his chocolates. Ivan's profitable business is now losing money, and he still has to repay the loan for the new factory. Ivan realizes that building the new factory was not a sound decision, and unfortunately, he's now forced to lay off workers and restructure his business. And this story replays itself throughout the economy with countless entrepreneurs like Ivan. The Austrian school's view is that distortions in interest rates play a major role in business cycle booms and busts.
Again, there's different thoughts and philosophies as to why cycles happen, and there's certainly different people that have a take on this. I tend to lean more towards this particular line of thinking as it relates to economics. I think the Austrians have a pretty good take on how things actually work. Although, the argument can be made that the cycle is softened because of the Keynesian style of raising, printing money and this kind of centrally controlled monetary policy. I think the argument can be also made there that softens the cycle to some degree, or the busting cycle, or makes it a little bit more predictable. But I tend to think more along the lines of the Austrians. I think they have a lot more explanation as to what actually is happening. I think they tend to look at things like what has happened in terms of the amount of money that's come into the cycle, the amount of money that's flooded the zone, and what it does. I think we are all feeling it, I think, on every level, whether that's $4 gas or $6 milk, or shortages at the grocery store, different things that are happening. I think most of that is not as transitory as people might want to make it. I think it's a real thing, and I think it has a lot to do with the amount of supply of money that's in the system. If you remember from some of the other episodes we talked about, the Federal Reserve only creates a certain amount of that supply. Most of that money is created within the banks, and when credit's cheap, they really do a great job of pushing that out, lending money out, and creating more money than would otherwise be in the system. So just something to watch. I think it's a really interesting thing. I think that video helps explain a little bit of what's going on, certainly from one perspective. I want to get into statistics locally at the group. From the group, I think they do a great job. I've always appreciated their analysis of our marketplace. It's on their website, thegroupinc.com. You can find this, it's readily available. This is my take on it. Some of the things that I look at when I'm going through their statistics. These are released every month. So you're welcome to go look at this anytime you want and kind of get a read on what's going on in the market. It's one of the center tabs, kind of just our marketplace is one of the tabs. And you can look at it and see what's going on. And I think it does a great job of showing what's going on. So this is my take. I'm going to go through the statistics. We'll go through each kind of slide, and I'll be able to explain to you what I'm looking at, when I'm looking at these things. Might help you in the future, might help you understand analytically what's going on in our marketplace.
All right, these are the April statistics assembled by the group. This comes directly from our IRIS system. First thing I want to talk about is interest rates. You can just see how interest rates have been going down since probably about 18, and they're moving back up here starting December of 21. We really start to see that interest rate move up. We're currently at about a 5%, as high as 5.25%. Annual appreciation, this is a really interesting thing to notice, is that you can just see really high appreciations. One of the ones I want to point out is 1979. Crazy amount of appreciation in Fort Collins. We're starting to see a similar bar in 2021. I think 2022 will be probably a little bit similar to that. Same thing for Greeley. Pretty high marker there in terms of the annual appreciation, over 16% in Greeley. Market summary. So this is an interesting thing. I look at overall amount of new listings and how they go across. You'll see everything is down in terms of the overall number of listings, closed sales, all of that's down. That speaks tremendously to our lack of inventory. Greeley is an interesting highlight in here at 63% of closed sales. That's up significantly over the year over year. This is a year over year analysis. I do think it does speak to the fact that there just isn't that much inventory in our market, more than it is that there's some kind of dropping in what's going on. Same thing we want to look at here in Timnath, Wellington, Severance, and Berthoud. I like to look at these outlying communities because they're really the first indicator that maybe inventory is moving back up. What you'll see, one of the ones I want to point out is Severance at 69% down over new listings year over year. That has everything to do with the water moratorium. This is also kind of a canary in the coal mine for me. I like to look at this is kind of what's happening in these smaller communities. Timnath's one that has a lot of new construction. Harmony Club and Wild Wing are both finished, which were kind of the dominating kind of things out there, and that's what you'd see in April 2020. That takes 121 days to close a house. We're down to 23, and we're seeing that as 104% of the asking price in what's going on in that little town. So while I do think that certain things in relationship to the recession may be coming, these are indicators that say that we still have a fairly robust market at the moment, showing that we still have short days on market and an incredible amount over the asking price. 4% doesn't sound like a lot, but when you're talking about $1 million properties, that's $40,000. Dollar volume, Fort Collins, you'll see in April 2020, that dollars were around $100 million. We're at $156 million in April of 2022. Less housing sales, but much more volume. That speaks to the amount of price. If you look at the bottom, I think that's really interesting. In April 20, we were at 98.5. That's coming right out of COVID. That seems to be a relatively healthy number. Now we're at 106.3. So that's an 8% increase almost in terms of your overall price over your asking price. At $500,000, that's a lot of money. That's $40,000 that would be over and above, and we're seeing that a lot in contracts. You're seeing people actually stretch really far and putting these kind of giant numbers over and above, waiving appraisals, all that kind of stuff, that's an indicator that people are willing to overpay because the inventory is so low in our communities. Okay, we're going to look at the same thing for Loveland. You'll see dollar volume at 59,000 up to 88,000. Really interesting here to look at also Windsor, so same kind of thing, 40 to 81. That's a huge jump in terms of the overall number of volume, $40 million to $81 million worth of sales. So now this is the crazy one. This is Greeley. We're going to look at $38 million, $36 million closings back in 2020. That has moved up almost to $100 million. It's a crazy amount of stuff that's going on in terms of the numbers. Still days on market are fairly healthy. I mean, still quite incredible. This speaks to a lot more that people are with loans are going over to Greeley instead of cash buyers. So Greeley's still a healthy market for people that are looking to get into that first-time home buyers market because it's still a place that people will accept pricing with conventional financing. Okay, this is closed sales. We're going to look at Fort Collins first. So closed sales, 254. That's not a tremendous amount of closings in a given month. Average median price is $550, and our total price per square foot is moving at $286 per square foot. That's really close to almost new construction pricing, honestly, in this area. Loveland, same thing, 148. We've talked about the lack of inventory. This demonstrates it significantly here. Median price, again, $550. That's moving pretty high. Here we are in Windsor. Median price is $630, 112 on the market. New construction pricing indicates this is going to be something that there's a lot of journey homes happening over there. 209 is a price per square foot there. They're going to be a pretty dominating portion of that 112 sales for that month, and that's going to be one of the reasons that that number is down. But overall, again, your median price in Windsor is $630. It's almost $100,000 more than other communities around here. And then we'll look at Greeley. I think this one's pretty interesting. You look at 219 sales, $449 is the median price. So about $100,000 less than Loveland and Fort Collins, but you're looking at a sales or a square footage price of $197 per square foot. Let's take a look at new listings. This one I think is really interesting. If you go across, you'll see that there's 341 new listings. Number of homes for sale currently that hit the market in April were 155. Those that went under contract were 288. That will speak tremendously to the idea that a lot of houses aren't even hitting the market. They are on the market, or they came on the market, or they're kind of a pocket listing with someone, and they're being sold. It speaks to the value of a broker, I think, in this case, that they're hearing things and seeing things and networking before things even hit the market. And I think it's very helpful to understand that, seeing that in relationship and context to how many sales. 155 is just not very many houses hitting the market. We like to see somewhere in that 400 to 500 to feel like that's a reasonable inventory in Fort Collins. Here's Loveland. Again, 321 in 2020. We're down to 97 listings in Loveland. That's why the pricing has shot up so significantly. You'll also notice that there's 184 sales. Again, speaks to things that are hitting the market that are not going on IRIS or not going on MLS. They're being done ahead of time just so that people can get their house sold and taken care of quickly. Here we're looking at Greeley as well. Same kind of situation, not as dramatically different in terms of the number of sales and the number of under contracts.
Okay, so another question, this is a great question that I got this last month, which is what are great returns on investment if I'm going to, the inventory is not, I don't want to move. It doesn't feel like I can even find something that I could move to that would be better than where I'm at. So I don't want to move, but I want to make some improvements to my house. What are our best uses of dollars in terms of doing that remodel? So I was actually surprised by this. This is from Zonda. There used to be a group around called Metro Study. They've been bought out. Zonda is kind of a large, statistics and research group around that does specific things to housing. So they've done this report for 35 years. This is their report on what are the valuable things to do for remodeling, or and if you're going to remodel, where do you spend your money? So I thought these were super interesting. I was surprised that the most valuable return on investment was a garage door, believe it or not. Upgrading your garage door, people seem to think that that's really important. Makes a ton of sense, I guess, if you make some analysis empirically about it and try to recognize why people might think that that helps. It does dress up the street. It is one of the most predominant elements of architecture on most suburban houses, so it makes some sense. But I thought this list was really fascinating, super worth looking at. So here's that list and my breakdown on it.
Here are those top 10 projects. So number 1 is garage door replacement. You'll see about a 93% return on investment based on what sales are out there. We kind of work our way down through all of these things. As you get towards the bottom, some of these steel doors or composite decking or wood deck addition, what you're going to see is that you do get some return of investment on it, but most of that is about enjoying the house while you're in it. So really the only one that, every one of these actually doesn't necessarily make you more money, but it does help you live a more enjoyable time in your own home. And then when you do go to sell it, some of these costs ultimately can be recouped in the process.
All right, the last thing I want to talk about today are rental rates. This has been something that's been really something I've been monitoring. I try to monitor it every month when we do these things to try to get some sense of where we are. It's been really hard to find a good rental deal out there. A lot of these deals are just not very healthy right now. They are in a position where, you know, the interest rates are climbing. You have to put more money down in order to make them cash flow. Banks aren't looking at them as favorably without that giant layout of cash at the beginning. And I think really to make something cash flow, and this is talking about kind of breaking even with management, I think you need to be in that 30 to 35% down depending on the deal, especially with interest rates at 5.5%, 6% for those that are non-owner occupied. So, you know, it's hard to make these things work, but what I am seeing in the marketplace is an increase in rents. So I wanted to go through our 4 major markets in terms of rentals around here and give you a sense of what those things are. So first one is, obviously we want to talk about Fort Collins. That's kind of the big one that everybody wants to talk about because that's where most of the housing and rentals are actually happening. In Fort Collins, we're seeing a range, and all of these are going to be for a 3-bed, 2-bath house. And I'm kind of just taking a range. Everything has different issues and reasons. I didn't even get into apartments because HOA stuff gets really complicated there to kind of make apples to apples comparison. But a 3-bedroom, 2-bath house in Fort Collins, we're seeing kind of on the low side in this $2,400 a month number, all the way up to $3,200. So that's kind of seeing that needle move a little bit. That's a pretty wide range, $1,000, but I think in the broad scope of things, gives you a sense that maybe on the college rental side, all the way up to those that are looking for a nicer house, we're still in this $24,000 to $3,000 number. In Loveland, which is something that has always been a little bit lagging behind, it's a little tighter. The university doesn't have nearly as much play on this, and the people that are renting houses in Loveland actually can get a little bit more value out of it because they don't have the U+2. And for those of you that don't know what U+2 is, that's a Fort Collins policy that only allows yourself plus 2 unrelated parties to occupy a house to keep the numbers down to 3 total parties that are sharing a home. That's not the case in Loveland, isn't the case in Greeley, and isn't the case anywhere else except for Fort Collins. And so actually out of Fort Collins, you can get a little bit more bang for your buck in terms of the bedroom, the overall thing. So this is a 3-bedroom analysis. So when we get to 4 and 5 bedrooms, you'll actually see these things increase significantly. In Loveland, you can actually start to see those numbers jump up towards $28,300, $3,200 for 4 and 5 bedrooms, because you can actually get a little bit more per bedroom than you can in Fort Collins because of that policy. But for a 2-bedroom house in Loveland, we're looking at a range between $2,000 and $2,400. A little tighter because of those other factors that are in there, and that allows it to be a little bit tighter range in there. But yeah, $2,000 to $2,400 seems to be about the range in Loveland. Windsor's a little higher, $2,600 to $3,300. A lot of that is new construction, and again, they don't have the same policy of allowing that. So you can have this, you know, if you had 5 parties or 5 roommates that could theoretically rent a house together, you can actually raise that number per bedroom and get yourself into a situation where that house actually rents for more money. And then lastly, Greeley. Greeley always lags a little bit behind in terms of its overall value in our market there, but we are seeing those numbers between $1,900 and $2,400 for a 3-bedroom, 2-bath unit over in Greeley. So I think that's kind of cool. I think it's kind of fun to make that analysis, take a look at it, understand what that looks like in relationship to if you were looking to do rentals, how does that work? And how does that actually impact your ability to cash flow a rental and have it as an investment? Appreciate everybody that's listening and watching these. I like sending them out to all the people that are in my sphere of influence and people that want to trust me to do real estate with them. I'm very much appreciated. I hope that they're educational and that they give you some breakdowns as to actually how things are working in our marketplace. Appreciate everybody that does watch it. Appreciate everybody that's done business with me, and hopefully we'll have a chance to get together and grab a cup of coffee or a beer and have a good discussion on real estate anytime you want. I'm always available and would love to visit with you anytime. So thanks for listening, and we'll talk to you next month. One thing I do want to highlight is that there are I'm producing videos often on my channel that just have unique things. So one of the ones I did just recently was on pricing and interest rates. If you want to check out the channel and subscribe to the channel, I think it gives you a little bit of, every time I produce a video, you can see it, and it'll alert you that there's something out there on YouTube. So take a moment to do that, and then if you wanted to find out more about what's going on in terms of what's happening, I try to do these once a week. I don't send them out in emails to you. I just put them on the channel for anybody to watch them if they want. So they're there. I'd check it out, subscribe if you have interest, or if you think I have a smittance of value to add to the real estate conversation, go ahead and subscribe, and I'd appreciate it.